So guys, we're finally at the point where we're actually going to be looking at bonds and yields in depth. And this is probably one of the most important lessons. And obviously the next few lessons where we explore yield curves and everything like that. Because unlike other asset classes like stocks, for example, bonds has a direct correlation with the actual government because there are government issued bonds, the treasury market. And this had such a big effect on particularly DXY. And from that, you can understand what it means for our actual currency pairs that we're trading. Because at the end of the day, we want to use, this fundamental knowledge to understand, okay, where is our directional bias? So as we know, bonds are used as a relatively safe investment since it is backed by the government. When there is an attractive yield on the bond, that interest rate paid back to the bond purchaser, this can cause lots of investment and causing economic growth. Now, you understand what there is to know about bonds, but there is slightly more we can know about bond yields, which is arguably the most important piece of information to us as forex traders, since we can understand the impact of interest rates and the potential strength of a currency. Bond yields are excellent indicators of the economy as a whole and of inflation in particular. This is the one thing that economists really do look at in detail, especially when it comes to graphs as well, actually looking at the chart work. Because the thing with a lot of fundamental economists, they look at a lot of data, but when it comes to actual chart work, there's not much technical work that they do like us when we're doing this, the so-called smart money concepts. So by now you probably understand the bond and its yield are inversely correlated. So as a bond goes up, the yield goes down. Now let's look at it in two conditions. Of course, the two that we always refer to, because that's what we're trying to understand all the time. In an expansionary condition, inflation rises. Interest rates are expected to rise to slow down that inflation. So that's what the Fed will do to counteract that inflation. As a result, the bond yield will increase and therefore the bond prices decreases. Now, in contrast, for a deflationary condition, inflation decreases and the economy slows down. As a result, the Fed reduces interest rates to promote economic activity. Therefore, bond yield decreases because of the lower interest rates. And as a result, due to the inverse correlation, bond prices increases. The important factor here is that we can use the bond yield curve to predict future economic activity. It can be used to estimate when we are where we are in the expansion cycle. So not just the expansion cycle, but the market cycle that we looked at previously. And the thing is, always refer back to that and actually have it drawn up with the characteristics of every sort of component. So what do we mean by the yield curve? So as we've been explaining, you've obviously got the bond price, but the yield is particularly important to us and also economists. And they use this chart right here called the yield curve. They've got the yield on the y-axis, the maturity on the x-axis. So just as an introduction into the next lesson where we're going to be looking at these in real depth, investing in long-term bonds like 30 years is more risky. Now, the reason for that is because price changes more over time due to the interest rate changes, over the course of the 30 years. Hence the reason that the actual people that, are involved in the 30-year bonds, they're compensated with higher yields to cover the effect of the risk. So as you can see on the chart, the yields with, the bonds with the lower maturity, so the lowest you can go is 3 months. That yield that you're going to get, so the return you're going to get on that is very low. However, if you compare that to the 30-year, obviously we haven't got numbers here because this is a diagrammatic chart at the moment. But the 30 years has the highest yield because the people that are, the investors that are involved in 30-year yield, 30-year bonds, they're very overexposed for all of that time, right? And in that time, what happens? Interest rate changes up and down and they fluctuate. So this this obviously isn't that attractive. So how are they compensated? They're compensated with the higher yields that they're promised, as shown here. And also the opposite is true for shorter time frame maturity bonds. There is less risk because you're only waiting 3 months for that return. Therefore, your yield on that or your return is a lot less. Anyways, guys, this was just an introduction into bonds and yields. We're going to be looking at the yield curves in depth in the next lesson. Anyways, guys, take care.